Welcome back to the third video of our series From Zero to LBO, building a financial model of Twitter. In this video, we will finalize our integrated and dynamic three-statement model, adding a forecast and additional schedules. The objective is to close our model of Twitter to simulate a potential future development. Although our model is pretty simple, we will have a nice and flexible tool to analyze Twitter, allowing us to manipulate different KPIs, thereby looking, for example, at the measures considered by Elon Musk. We will cover this analysis in detail in a later video after we finalized the DCF and LBO model. So for the moment, let's get started. Before we dig into our model, please ensure that you have enabled iterative calculations, which you find in the options section under formulas. We start off with a model we prepared in our last video. So there we basically copied the relevant data from the 10K of Twitter using the finance schedules as well as the supplementary data in the annual report of 2021. In addition, we defined supporting schedules to model the changes of certain assets, which included cash as well as non-cash items. For example, property and equipment. We calculated the change of the balance sheet item using information on investments and the associated depreciation. So, as I said in the previous email, the task here would be to read through any document like annual reports, quarterly reports, etc., and asking yourself the question, what is cash relevant and what not? The question seems rather simple, but could lead to interesting conclusions like, for example, stock-based compensation, which we will explore in our analysis video. But for the moment, we focus on the technical aspects of the model. So the first step would be to create a new sheet which will include all the assumptions and KPIs we define to forecast our model. So to spare some time, I will fast forward and show you how the final structure could look like. So this would be our KPI and assumption sheet. What we did here is we copied the layout of our model template, added our forecast years, and then just simply copied the line items from the model using a formula to do it a little bit quicker. So please note what we did here is we copied each cost and expenses which is not covered in a schedule. For example, what is missing in this list here is depreciation and amortization, which we model further down below, and I'll show you that in a minute. So the possibilities to model or forecast any item range from highly complex submodels to simple percentage of revenue calculations like we did here for the expenses or costs. You may ask what is the best way, and to be honest, there's no clear answer, and it also depends on the purpose of the model. You have to find the best trade-off between level of detail and ability to source relevant data for your forecast. So don't get lost in details. Usually the key input is revenue. Therefore, a solid basis for your revenue forecast is a good starting point. As you walk down the road of modeling, you will find other meaningful sources to forecast various items. Modeling also means to enrich your model with new information from time to time. So getting started is key. In this respect, we primarily focus on revenue development. Therefore, we will in a later video define different revenue cases based on daily user development to create something like a price quantity structure. For the moment, we will purely look at growth rates. And what we did here is we calculated the historic growth rates of Twitter. And for the moment, just hard-coded future growth rates. The same we did in somewhat same fashion for costs and expenses. However, we based the calculation on a percentage of revenue, meaning that we took, for example, the historic total cost of revenue and divided it by the revenue of the respective year to arrive at the revenue for the past. So as you can see here, this year is based on our definition, a calculation. What we are modeling are the sub-items which we defined in our earlier video. Here, the residual cost of revenue and stock-based compensation. Depreciation, as I mentioned, is covered in the respective schedule. So we added all the respective line items, expenses, and costs to build something like a forecast for each line item, which you can freely manipulate. But for the moment, we just stick with the last historic value. You could, of course, use the average of the past 3 years and so on, and we will see in our analysis video what would be the effect on that. As a check, we added also a total cost and expenses in percentage of revenue line to see how the overall development is over the planning or forecast horizon. And as you can see, there's a constant decline in cost and expenses, obviously leading to a rise in profitability. We take that in mind when we look at the analysis, but for the moment, we purely focus on the technical part in defining the forecast. Next, we model other income. Other income is primarily modeled using absolute terms. As in the case of Twitter, other income was primarily unrealized gains or impairments, meaning purely book value. So what we assume for the future is that there is no change in this line item. Next, we look at interest expenses and interest income. Here, we help ourselves with a shortcut. So what we do here is we calculate the historic interest rate or yearly average interest rate paid by Twitter on all the debt instruments, which are quite a lot. If we look into the 10K, what we do in a second, but we take the historic interest expense and relate this to the underlying debt instruments, what in our case would be convertible note short-term, finance lease liabilities short-term, and convertible notes and senior notes long-term. if you look at the formula, what we did here is we calculated the average of the previous year and the current year to accommodate for the timing aspect of borrowing, meaning that Twitter is taking on debt throughout the year, and to have something like an averaging effect on that, we calculate this average. So if you would like to model it in detail based on the single debt instruments, you could look up the relevant section in the 10K and see what supplementary data you find here. And you obviously find, for example, the underlying convertible notes, including maturities and including interest rates. This is another more detailed way to calculate interest expenses and define schedules for each instrument, but for the sake of time, we skip this rather detailed process, as we also lack certain data to build meaningful schedules. Next, we do the same calculation for interest income. So in principle, the same logic as for interest expenses applies for interest income. We use the historic interest incomes and calculate the average yearly interest rate, looking at the underlying cash and cash equivalents and short-term investments. We also use yearly averages on the balances to accommodate for this timing factor. Next, we calculate the income tax rate, which in case of Twitter plays a major role in defining profitability. So this is something you should have a closer look when analyzing a target company. In case of Twitter, a major part are related to deferred taxes. If you look up the respective section in the P&L, you see that in the past there have been quite some shifts in profitability related to deferred provisions or benefits for income taxes. For the moment, we will assume a tax rate which is typical for companies like Twitter. So what we use here is the effective tax rate calculated by Professor Damodaran, which we utilize as a proxy. In our analysis video, we will also discuss how we could treat deferred taxes in light of the future development, as this is, of course, a significant figure to define profitability of Twitter. So after we defined income taxes, we concluded the forecast of the profit and loss statement, and now we focus on the balance sheet to define forecasts of the respective items. First off, we start off with accounts receivable, and as you can see, we model accounts receivable also using revenue development. However, we incorporate a timing factor in that we look how long does it take to convert accounts receivables into revenue, or better, into cash. This so-called day sales outstanding is a KPI giving you an insight on how long does it take on average to collect respective payments. The shorter, the better. So this is a key measure when it comes to working capital management and to define the financing power of working capital. Especially in the retail world, DSO is close to zero, meaning that cash collection is ultimately performed when customers are buying assets or buying stuff at the store or online shop. And this has some major implications on working capital financing in the retail sector. Maybe we can do a similar series for a retail company in the future. So looking at the formula, what we did here is we divided accounts receivables by total revenue and multiplied it by days doing business. So we assumed here 360 days. This could vary to 250 or something in between. You have to be consistent when looking at other items you are forecasting in this manner. So looking at the future, we also here use the last year as a proxy to model future developments. Next off, we look at prepaid expenses and other current assets. This primarily relates to unbilled revenue consisting of amounts that Twitter is contractually entitled but have yet to be billed. Therefore, we model this as percentage of revenue. Next, we look at operating leases. This primarily includes leases for office space and data center facilities, which are accounted for as asset and liability, outlining the contractual obligations of the lease agreement. The treatment of leases, either finance or operating, has changed since ASC 842 was declared a US GAAP standard. Under the respective regulation, all leases are recorded on the balance sheet unless the term is below 12 months in case of operating leases. The P&L recognition, however, differs as lease expenses under operating leases are recognized on a straight line basis over the lease term, whereas finance leases require the lessee to recognize interest expenses and amortization of the respective asset, leading to a higher initial expense. The treatment of leases could affect the financial performance and valuation quite a lot. Therefore, the treatment of leases should be analyzed in detail. In case of Twitter, we focus on operating leases, or the overall focus of Twitter when it comes to leasing is on operating leases, as we see in the balance sheet. Finance leases do not play a significant role or do not play any role in Twitter's current setup. So what we do is we focus on operating leases and calculate it as a percentage of revenue to forecast it as a somewhat working capital item in the future. So deferred tax assets are next. As I said, in relation to the income tax forecast, this refers to future tax savings or reductions in income taxes. And we model it in absolute terms, meaning that for the moment we assume that assets, and as you will see in a second, liabilities will not change in the future. Other assets, meaning restricted cash and the residual value, is also forecasted in absolute terms. Restricted cash is constant over the forecast period, and the residual value is defined as percentages of sale. Investment in privately held companies, which is also part of other assets, is modeled further down below in the supporting schedules. As is with all the other missing items you find on the balance sheet. like for example, property and equipment, intangible assets, goodwill, and so on, which we will forecast in a moment. So next we look on the liability side, starting off with accounts payable, which is similar to accounts receivable. We also look at the timing aspect. However, we do not use revenue. We will use cost of revenue as the basis. Ultimately, as you can see above, still revenue is the key driver. But in case you would later define another planning methodology, the cost of revenue would be factored in already. So what is sometimes done to forecast cost of revenue is also a breakdown into a somewhat price quantity structure, not depending on the revenue development, meaning on prices relating to materials or services needed to conduct the respective business model. But also here you need additional information to have a meaningful planning basis. So in our case, as I said, it's ultimately referring to the revenue development, as cost of revenue is also forecasted using the overall revenue development. So maybe we will find another company which we can showcase how different approaches in planning could be conducted. So days payable outstanding represents the same time logic as in DSO. However, in a reverse order, meaning that the figure states how long does it take on average to pay suppliers. Therefore, the longer the better when it comes to a cash flow perspective. Although Twitter has no inventories on the balance sheet, the combination of DSO, DPO, and DIO, the equivalent for the average days of turnover of inventories, defines the so-called cash conversion cycle. This measures the time to build up liquidity through working capital. The other liability items are forecasted similar to the asset side, primarily focusing on percentage of revenue or growth rates, like for example, the accruals. Operating leases are the equivalent to the assets. We model it as a percentage of revenue. Deferred and other long-term tax liabilities as the assets modeled forecasted, assuming no change to the last historic value, and other long-term revenues are planned using percentage of revenue as the calculation. Last but not least, looking at the balance sheet, we forecast changes in equity, meaning that these changes include every possibility like capital raises or dividends, however, excluding net income, which is accounted for in the cash flow statement. So next we will have a look at the asset schedules, which we defined in the previous video, looking at short-term investments and assets held for sale. We assume no changes in the future, therefore using a rather simple absolute change forecast method. And in a later video, we will utilize short-term investments as a source of liquidity for the later LBO. Next, we model property and equipment, which is planned using investments as a percentage of revenue. In similar fashion, depreciation is calculated using the beginning balance of property and equipment plus 50% of the investments of the respective year. And this percentage is then utilized to calculate the associated depreciation in the forecast period. So as stated with the interest expenses, an alternative approach here would be to build dedicated depreciation schedules factoring in the respective useful lives of the single assets underlying property and equipment. However, we use this simpler approach due to lack of data and our overall purpose of the video explaining how such models work. The same logic applies for intangible assets, which primarily includes patents, developed technologies, and assembled workforce assets which were acquired or capitalized by Twitter. So investments are also planned in as a percentage of revenue, and amortization in this respect, not depreciation, is calculated using the beginning balance plus 50% of the acquired or capitalized intangible asset. Last but not least, we plug in goodwill and investments in privately held companies as absolute values, assuming no changes in the future. So looking into the balance sheet, we are nearly there. The only missing items are the debt instruments. Here we define a separate debt schedule to forecast the respective instruments. We define short-term convertible notes and finance lease liabilities as absolute changes due to the fact that both do not play a role in the future or in the last historic year of Twitter when it comes to the financing structure, as you can see in the balance sheet. However, what we assume is that we are using cash and cash equivalents to reduce long-term senior notes and convertible notes, and hence lowering the overall leverage of Twitter. This is solely an assumption outlining a potential way to incorporate debt services into a model. So what we did here is we calculate the available liquidity prior to debt service, considering the previous year balance of cash and cash equivalents, adding operating cash flow and investing cash flow, as well as change in equity and changes in short-term convertible notes and finance leases of the financial cash flow, which are zero, and we deduct a minimum level of cash and cash equivalents, which we assume to be 250 million. So you're free to model in any number. This is just an example. So this available liquidity is then utilized to calculate the change in senior notes, in long-term senior notes, which is simply calculated as the minimum of available liquidity and the current balance of long-term senior notes of the previous year. So this, in our case, results in a payback of the long-term senior notes, as well as the payback of a significant portion of convertible notes. As I said, this is a simple assumption. In reality, you have to obviously check if this is possible from a technical or legal point of view, and if it does make sense. So the future years are then also used to reduce the liabilities of Twitter, resulting in an ever declining leverage. So this basically concludes the definition of assumptions and KPIs. We are now proceeding to the actual forecasting by linking the relevant line items in the model spreadsheet to the assumption. Starting off with revenue, we simply take the previous year figure and multiply it by the growth rate in case of revenues. The same we do for the expenses and cost, which are, as you remember, forecasted using a percentage of revenue. Therefore, we take the current revenue and multiply it by the respective share. Interest expenses and income are then calculated based on the same logic as we calculated the historic values. So we take the average balance of the underlying debt instruments and multiply this by the calculated interest rate. Same for interest income to arrive at the respective figures. Please be careful looking at the correct sign. In case of interest expenses, it's negative. In case of income, it's positive. Next, other income is just linked to the assumption sheet, and income taxes are calculated using income or loss before income taxes to calculate the respective income tax figure. Next step would be to forecast the relevant schedule, as the schedules are always the basis for the calculation, meaning that the balance sheet is also linked to the respective underlying asset schedules. So here we simply link the assumptions to the relevant line items. In case of property and equipment, we use the factor calculated based on the historic values and multiply this by total revenue. In case of depreciation, we consider the starting balance at 50% of investments and then factor in the percentage calculated of the respective depreciation. Same logic applies for intangible assets. Here we only look at the net balance, as these two figures were based on the data we found in the 10K, but for the future we assume that everything is incorporated in this line item. Amortization is calculated in the same logic as for depreciation under property and equipment. Goodwill is assumed that we only have acquisitions. These reclassifications we accounted for in assets held for sale are assumed to be a one-off in the past, therefore no change in the future. Same as for other, we directly plug this in here in the schedule, not in the assumption sheet. And last but not least, we plug in the assumption underlying the development of investments in privately held companies. Based on that, we add the respective balance sheet data. So cash and cash equivalents is the plug. This is the last step which we would perform. I will explain it to you in a second. So first we link the items which are modeled in the asset schedules, like for example short-term investments, to the respective asset schedule, and everything else to the asset spreadsheet, like accounts receivable, prepaid expenses, operating lease assets, and so on. The same applies for the liabilities, accounts payable, accrued, and other current liabilities. Changes for convertible notes are plugged in using last year's balance plus the change we defined in case of short-term convertible notes in the asset spreadsheet, in the assumption spreadsheet, sorry. And for the long-term convertible notes and senior notes as calculated, utilizing available liquidity and the minimum cash, which we also defined in the assumption worksheet. So based on that, we finalize balance sheet data by calculating the change in stockholders' equity, starting off with the previous year, adding net income and the changes we defined in the assumptions spreadsheet. After we forecasted the balance sheet, we simply copy our year-on-year change of balance sheet data we defined in the previous year for the coming years, and do the same for our cash flow statement, which is derived from either the year-on-year change, the balance sheet items, or directly from the asset schedules to calculate the total cash flows. So the final step then would be to close the model and calculate cash and cash equivalents, which is simply the ending balance of the previous year plus the calculated change of total cash flow, which after entering the value should result in a matching balance sheet, meaning asset and liabilities are the same, no difference. And as an additional check, we see that the change of cash and cash equivalents is explained through our cash flow statement. So this concludes our video for today, and we finally have a dynamic and integrated three-statement model, including a yearly forecast. Next, we will build a DCF valuation on top and see how much Twitter is worth based on our assumption. I hope you enjoyed this video, so please subscribe to stay up to date and get a notification as soon as we upload another video of our series From Zero to LBO, Building a Financial Model of Twitter. In case you're interested in the final Excel model and the step-by-step documentation outlining the detailed build-up of the model, please write us an email to the address in the video description. As you can see in our documentation, we have outlined every step we just briefly showed in the video that you can build the model from scratch. So, thank you for watching the video. We are looking forward to speaking to you in our next video. Bye bye.